The US stock market went on a tear in the first quarter. S&P 500 rose by 7%, while Nasdaq went up 16%. This is despite the biggest bank failure in 15 years. This is notwithstanding growing tension between the US and China, the two largest economies in the world. Stock market bulls have been taking no prisoners. Now they even have history on their side. History says that when the US stock market does so well at the start of the year, it bodes well for the rest of the year. Will history repeat itself, or will the pattern break in 2023? What does the bond market have to do with the stock market rally? How many different ways are there for things to go wrong? What should you be doing with your money right now? One of the most talked about developments in financial markets over the past year has been the emergence of an inverse relationship between US stock prices and US government bond yields. As you can see on this chart, stocks have gone up whenever bond yields have gone down, and stocks have gone down whenever bond yields have gone up. A negative correlation between the stock market and bond yields is not unheard of, but it's gotten pretty extreme. Indeed, the correlation between S&P 500 and 10-year US government bond yields is at minus 30% over the past year. At minus 30%, it has not been more negative over the past 10 years. The stock market is so busy shadowing the bond market these days that other drivers of stock prices like growth momentum have fallen out of favor with investors. Talk about a one-track mind. What happened over the past month is a good example of this. After the troubles of Silicon Valley Bank hit the headlines on March 9th, S&P 500 took a big dive over the following 3 trading days. But it took little time before it came storming back. As of April 5th, S&P 500 has not only completely retraced the decline over those 3 days, it is now flirting with its year high of 4080. So what drove the stock market higher? You guessed it, a big decline in bond yields once the market learned about Silicon Valley Bank's troubles. 10-year US Treasury yields have fallen from 4% on March 8th to just 3.3% as of April 5th. The decline in bond yields is the result of the market pricing out another 50 basis points worth of Fed interest rate hikes. As of April 5th, the bond market has decided the Fed is done hiking rates, and its next move will be actually an interest rate cut. You might be wondering how lower bond yields could have had such a big impact on stock prices. You might be wondering if this is because lower bond yields reduce the unrealized losses of the securities holdings of other banks like Silicon Valley Bank. Is it because lower bond yields reduce the risk of a full-blown banking crisis? Apparently, the stock market is not as smart as you. There is no evidence to suggest that this reasoning is behind the latest buying spree in stocks. To see this, all you need to know is that the stock market has gone up despite the fact that bank stocks are still down in the gutter. If anything, the stock market is trading as though the banking crisis is the best thing that ever happened. How on earth can this be? The stock market bulls appear to be guided by the following logic. The banking troubles will force the banks to reduce lending, which in turn will lead to a slowdown of the economy. This will accelerate the decline in inflation and reduce the need for the Fed to raise interest rates again. Apparently, the bulls are so impatient for the Fed to stop hiking rates that they welcome an economic slowdown if that's what it would take for the Fed to pause. Of course, with the caveat that the economic slowdown does not lead to a recession. There are 3 potential scenarios for the US economy over the next 6 months. A soft landing, a hard landing, a no landing. In a soft landing, the economy slows enough for the Fed to cut rates, but not enough to push the economy into a recession. In a hard landing, the economy enters a recession and contracts sharply. A no landing scenario is one in which the economy just keeps trucking along, and the Fed keeps hiking interest rates. The market is currently pricing scenario 1. The rally in stocks and the drop in bond yields over the past 3 weeks is consistent with a soft landing scenario. But what if the other scenarios were to materialize instead? The bond market would do well in a hard landing, but poorly in a no landing. For the stock market, it is more straightforward. It could do poorly in both. It would do poorly in the hard landing scenario because company earnings will suffer, but it would also do poorly in the no landing scenario because bond yields will then be much higher than they are now. If you want to make money, let alone not lose money, the challenge now is to predict which of the three scenarios will transpire. Personally, I would give a 40% chance to a no landing scenario, a 40% probability to a hard landing scenario, and only a 20% chance of a soft landing scenario. For that reason, I am neutral bonds, but bearish stocks on a 6-month horizon. Before I explain my thinking, let's talk about financial conditions, given the importance of this idea in the current debate on Wall Street. What you see on this chart is a financial conditions index for the US produced weekly by the Federal Reserve Bank of Chicago. What you see is that, at least based on this index, financial conditions have tightened quite a bit since the banking troubles began. Financial conditions are a crucial aspect of how modern economies actually work. Indeed, financial conditions can be thought of as the transmission mechanism for monetary policy. The thinking goes that when central banks raise interest rates, it leads to a tightening of financial conditions, which in turn brings about a slowdown of the economy and inflation. The current soft landing scenario priced into the market is predicated on the assumption that financial conditions have tightened so much that the economy will slow even without the Fed having to raise interest rates again. So what has been driving the tightening of financial conditions over the past few weeks? Let's start with the cost of borrowing by companies, a key aspect of financial conditions. The convention is to look at how much companies have to pay to refinance existing debt or issue new debt, compared to how much the US government has to pay for its own borrowing. Here is a chart of the spread for long-term borrowing by BAA-rated companies that are just one rating above junk. You can see the spread has gone up since the start of the banking crisis. In other words, financial conditions have tightened for US companies. However, the index is still quite a bit lower than the levels we saw in the second half of last year. What about the cost of short-term borrowing? In the US, many companies manage their short-term cash flows by issuing commercial paper. When we look at the difference in the cost of borrowing between lower-rated companies and higher-rated companies, we can see that it shot up immediately after the banking troubles broke out. However, it has since eased back. The bottom line is that companies that are able to access credit from the capital markets do not seem to have to pay much more for their borrowing, despite the banking troubles. What about households and small businesses that depend on banks for most of their borrowing? Is it possible that a loss of confidence by the market in the strength of their capital positions will force them to shrink their balance sheet, including reining back their lending? It is possible, but I don't think it's a given. My reasoning is that it is usually liquidity and not capital constraint that causes a credit crunch in a banking crisis. One way to measure how much liquidity is available to banks is to look at the spread in the borrowing costs between the banks and the government. No doubt it's gone up, but only back to levels that were prevailing for most of 2022. This is also evidenced by the fact that the largest 11 banks in the US agreed to park $30 billion at First Republican Bank last month. Counterparty risk in the interbank market has been also muted by the creation of the Fed's Bank Term Funding Program that's allowed banks to borrow money using their holdings of US government bonds at par value. The fact that banks are able to access liquidity, regulators don't seem to be pressuring them to raise capital, and that deposit withdrawal from regional banks has stopped, suggests to me that even if we are to get a credit crunch, it will be mild, or else being equal. The funny thing is that banks have been tightening their lending standards way before anyone has even heard of Silicon Valley Bank. However, this had limited impact on credit growth over the past year. I attribute this to the fact that delinquency rates so far have remained low. Delinquency rates on consumer loans is low because people have jobs and the labor market is tight. I would be much more worried about a credit crunch if we start to see big layoffs. The reality is the pace of business formation remains more than 30% higher than the pre-2020 level. The reality is that 40% of small businesses are still complaining about how hard it is to fill their vacancies. The reality is that even home sales is starting to pick up. The reality is that probably the most important transmission channel for monetary policy in the US is the so-called wealth effect. With NASDAQ up 15%, S&P up 7% year to date, and with strong bond returns, American households are wealthier today than they were basically when the year started. Given consumers account for 70% of GDP, as long as they keep spending, the economy should do okay. This is why, all else equal, I'm not too concerned about the negative spillover of the bank's troubles on the economy. There will be some impact, no doubt, but not enough in my view to force the Fed to start cutting rates anytime soon. This is especially the case given the Fed remains very focused on inflation, that is proving to be very stubborn. Jerome Powell is right to keep drawing the market's attention to the fact that core services inflation, excluding housing, is too high and showing little signs of coming down. Now you know why, if I have to choose between soft landing and no landing, I will go for no landing. That I said is bearish for both bonds and stocks. But what about a hard landing? But what about a hard landing? If I have to choose between a hard landing and soft landing, I would go for a hard landing. You might find my answer strange, but this is why. If we get a hard landing, it will be only because of additional shocks to the economy. I don't know about you, but I can think of a few shocks over the next 3 months that are potentially big enough to push the US, if not the rest of the world, into a recession. The first one is the brinksmanship over the debt ceiling in Washington that has the making of a crisis. In another video, I discuss extensively the question of why this showdown over the US fiscal future is important. I think the risk of such a crisis has grown since the indictment of Trump in New York. This decision to go after the former president has galvanized Republican voters and will only strengthen Trump's influence over his party. This will bolster the Freedom Caucus, Trump's strongest supporters in the House of Representatives, that want to use the debt ceiling to bring back some fiscal discipline in Washington. The showdown with the White House will start in earnest in May. While I cannot imagine the US defaulting on its debt obligation, I think the game of chicken is very likely to go into overdrive. The country is much more polarized than back in 2011 when we last went through a similar crisis. I struggle to see how this can end well. Another potential shock that can send the US and the global economy into a recession is if we see a serious intensification of the Ukraine war. As explained in my video last week, Zelensky is under pressure from Washington to launch a major offensive in the spring to show results. I think Putin's waiting for such an offensive to unleash Russia's military might. My concern is that if Russia manages to push back the Ukrainian offensive and inflict serious casualties on Zelensky's men, we could see a direct confrontation between NATO and Russia. Poland, a NATO member, has been warning lately of direct intervention in Ukraine if necessary. I would be surprised if the Poles will talk that way without support from Washington. It goes without saying that a broadening of the Ukraine war would be a disaster for the world and will send the world economy into a hard landing. Another potential shock is a direct military conflict between Israel and Iran. Reportedly, Prime Minister Netanyahu met with his Minister of Defense, Chief of Staff, and head of the Mossad on several occasions since the start of the year to discuss an attack on Iran's nuclear facilities. If such an attack were to happen, we could see a spike in oil price that will send the world economy into a recession. Such a spike is even more likely given the Western sanctions on Russian oil, and the fact that US strategic reserves are already at the lowest level since 1983. In summary, with stocks up and bond yields down over the past month, the market is pricing a soft landing that will be enough to stop the Fed from hiking rates, but not enough to send the economy into a recession. I think both a hard landing and a no landing scenario is more likely than a soft landing scenario. My view informs why I think the stock market is a sell on rally story right now. If you got something out of this program, please hit like and subscribe to my free YouTube channel. If you want to learn more about my investment strategy, come visit us at davidwuunbound.com. Thank you for listening.